Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, we do need to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, I know we have lots of exciting topics to get into for today's session. We have Nvidia's earnings on the horizon and lots of interesting material between the Fed and Trump as well. So interested to hear Rob's thoughts on that. And of course, very excited to interact with you all. So let's get right into it. Rob, you out there?
I am Zach, and I know you're under the weather. You sound pretty stuffy, so we all appreciate you powering through to be here with us today. And you kind of hit the highlights. Obviously, the market is awaiting the Nvidia earnings. The whole AI sector is awaiting the Nvidia earnings, and no question they're going to post some pretty good numbers, but how much does all the China stuff affect them is what everybody's going to be looking for, to see if that's put a dent in things, as China has kind of gone more the nationalistic way and encouraging Chinese companies to use China-based chips. That's all the stuff that people will be looking for in the conference call. And the market doesn't seem to care too much about President Trump attempting to fire Fed Governor Lisa Cook. The reason that's such a big deal is she's one of the voting members. There are 7 members of the FOMC that are voting members each and every month, and one of them has resigned, so there's one post open. And if she's gone, that means that President Trump appoints 2 new people, that he will obviously appoint people that are a little bit more dovish, and that could give him, along with the other 2 that he appointed last time he was president, would be a 4-3 vote in the Fed in favor of easing. That's why it's so much in the news. If you're wondering why we care, how they talk about all the independence of the Fed, et cetera. The only question is, some people are saying that President Trump doesn't have the authority, and the Federal Reserve Act of 1913, which if you ever saw me live back in the day when we were doing live seminars, I would do my little hour-long Fed dissertation, and I would talk about the Federal Reserve Act of 1913. And Zach, one of these days we will do our show on conspiracy theories. And I always used to mention during that, is it a conspiracy theory if it's based on fact? And there are a lot of facts about the Federal Reserve and who they are, how they operate, et cetera. But the president does have the authority for cause. So the question becomes, does listing 2 different residents as your primary residence for the next year constitute cause? So the administration is saying that's fraud, so that would be cause. But normally, the accepted cause is malfeasance, or basically not doing your job. So it's all going to be battled out in the courts. Nonetheless, the market doesn't seem to care today. We're bouncing back a little bit. I talked about this to our EWO live group yesterday. That's for our subscribers at ewotrader.com. We weren't getting a follow through. It seemed pretty clear. We do that during market hours as well, that we weren't going to get a follow through day from Friday's big move to the upside on slightly more dovish comments from Chairman Powell and Jackson Hole. But could we hold the 10-day moving average, which we did? And we are, and a little bit higher than this right now at the moment on the S&P. So all seems to be okay. If you didn't watch the U.S. market update over the weekend, please go do so. We get these macro charts from the same data scientists that do the AI for the Hub organization. And just real quickly, if by chance you're a new viewer and you haven't gotten a copy of this software, go to hub.com, hubb.com. You get the software for free. You get the Elliott Wave labeling. They aren't my labels. They're from an algorithm that the Hub organization has programmed exactly to the algorithm that Ralph Nelson Elliott wrote over 100 years ago. So it's right from the horse's mouth, so to speak. You do have an opportunity to subscribe to the AI signals if you want, but you don't have to do that to get the software and the LA Wave signals for free. That's something of your choosing. But the same data scientists give us macro charts. And I showed them in the US market update over the weekend. So go back and see that. And you can see that even though it feels like the economy is weakening a bit, we are still in expansion mode based on the macros. There are some elements that have contracted, but overall, the economy is in expansion. So if we do get a Fed rate cut in September, when the economy is hanging in there, so to speak, you can see how that could bolster the markets higher. The question at that time will become, do we get the FOMO? If they cut rates, do we get a big spike to the upside? The AI has been showing a target of 652 going all the way back to June, and we've been marching up towards that target. So way back here in the towards the end of June, the signal came out from the AI, and it looks like we are on a steady march to that level. But when does the wave 4 start? You can see that the 3 is labeled as green. That means it's still the active wave. At some point in time, we will get a wave 4. We had an opportunity twice, once with the non-farm Friday that I call it, and then we had the downward move last week that was immediately bought into. So this was when the viewpoint was that, gosh, we got Jackson Hole coming up, and Chairman Powell, if he maintains this hawkish stance, we could go lower. And then he kind of came out a little more dovish, and we had a big rally on Friday. And we're just consolidating that, still maintaining these highs here around where the wave 3 is, but can we push through that? So what I'm looking for is, if we do get the Fed rate cut in September, do we get a big spike higher? I think that's likely, as those that have been waiting on the sidelines. We know there's a ton of money in money market accounts that could come into the markets. Doesn't mean it's necessarily going to, but it could. Could we get a FOMO spike from the retail traders, a big spike higher? And then the expectation would be, okay, the Fed is officially in a rate cutting cycle, the market's going to go higher. But I think just an opinion right now is, if we do get a big vertical spike on a Fed rate cut, that could be the time when, okay, it's a buy the rumor, sell the news type of thing. The market has been trending higher on the expectation that at some point the Fed will cut rates. We don't know when that's going to be, but at some point. And so we get the rate cut, maybe we sell the news then and start the wave 4 down. That's just my opinion, for whatever that's worth. If we take a look at the VIX is going below 15. Wondering if it's going to make the move down towards 12 and a half. You know, I've been showing you this for months now, that last summer we traded right around the 12 and a half level, the lower level. We're coming out of the summer, as some of you reminded me on the US market update, because I've been talking about how this summer we stayed at 15 instead of 12 and a half. So where do we go moving forward? We have the normal less than ideal time of the year in August and September for the equities markets, at least historically, but nothing's 100%. You have to look at the situation at the time, and oftentimes moving into the month of September, we're not going through an expectation of a Fed easing cycle. So that's kind of keeping the VIX a little bit down, although slightly elevated at 15 for this summer rather than 12 and a half where it was last summer. So still slightly elevated on the VIX, but not significantly so. And if we do start to trend higher in the S&P, perhaps we trend down in the VIX towards 12 and a half. Those two would go hand in hand. Let's jump straight to the bond market and see how bonds are acting. This is the part that I find quite interesting as far as the markets The bond market, I talk about it a lot. If you're going to be an equities trader, trade derivatives on equities, options, etc., you need to have at least a working knowledge of the bond market. You don't have to be a bond expert, but just a working knowledge is a viable thing to do because there's more money in the bond market than there is in the equities market. Viewpoint is there's a lot of very smart people in the bond market, and the bond market has no idea what's going on. At least that's the way I read it. We've had these series of triangles, and as a reminder, if you're new, the TLT is prices on the 20-year. Prices and yields move inversely. So if prices are going up on TLT, that means yields and rates are going down, and vice versa. So we've had a little bit of a tick up here in rates, but nothing significant. And the tick up is on the longer end of the curve. On the shorter end of the curve, rates are actually down, which is interesting. Sounds like maybe we're starting to steepen the yield curve a bit. It's been flat, it's been inverted, et cetera, et cetera. But maybe the curve is starting to act a little bit more normal. Although I look at this as the bond market is not convinced on what the Fed is going to do. They're not quite convinced that we are going to go through a rate cutting cycle, but the markets all look ahead 6 to 9 months. So you go back and look towards more in the beginning of the year where prices were going up. Perhaps that was the anticipation of the rate cuts and a move down in yields. And now it's all right. The Fed cuts a little bit and then stabilizes. So perhaps that's what the bond market is telling us with the fact that it looks ahead. I always look at the bond market to get a cue on what equities are likely to do. So here's the TNX. And as I mentioned, a tick down in rates on the TNX. So shorter end of the curve, rates are going down. Longer end of the curve, rates are going up. That's how it's supposed to work on the yield curve. So it's a more steepening and a more normal. It's not significant. So I'm not trying to make it sound like, oh, the yield curve is great and it's showing that everything is wonderful. No, it's not showing that. It's just kind of ticking ever so slowly in the right direction as far as setting up a yield curve that is more in line with an economy that is healthy and a market that therefore can move higher when the economy is healthy. If we look at the dollar, we're still in Goldilocks land. You've seen me draw this corridor here for months going back to April. And I call this the Goldilocks scenario because the dollar is lower. And we're just sitting here in an ideal scenario for companies with international exposure on the exchange rate. And I don't want to see the dollar crater. And the reason for that is that I feel like we could start to get some comments again once we get past all the rate cutting and finally start the rate cutting cycle, et cetera. Then focus will be more on the dollar. And if we lose the dollar too far to the downside, somebody had posted on the U.S. market update, they thought the dollar was going down to 90. I don't want to see it even come down here to 92 and a half. I don't want to see it break this wave 5 low. As a matter of fact, down to 95, I think would be okay, but anything lower than that, and you start to wonder, will other countries continue to hold all those dollars, or will they just start dumping them and say the U.S. has too much debt, we're losing money on our dollar holdings, and we don't want them anymore? That would be a significant negative, I think, for the equities market. But for now, all we can do is analyze the data we have at any given moment, and for now, we're okay. In fact, we're in good shape with where the dollar is. And if you're wondering, well, why don't we want a strong dollar? Well, if the dollar gets too strong, it hurts companies with international exposure. And we have a global economy now. A lot of companies have global exposure. And if the price of the dollar goes too high, then it hurts the bottom line as far as the currency exchange. We saw that in earnings back here at the beginning of the year. Companies in the first quarter earnings, a few of them did talk about how that hurt. And now we're getting the opposite. Netflix, for an example, I use a lot because they were one of the few that actually commented on it. They were quite honest. They beat their numbers, but they said had it not been for the currency exchange being favorable, they would have slightly missed. And that's why Netflix didn't take off and run on the earnings report, because it was just kind of a in line earnings report, even though the numbers showed a beat, but the beat was because of the currency exchange. So hopefully that explains all that for those of you that might be a little bit newer to that. Looking at the Dow on the DIA, we finally made the new high. That was back when it was revealed that Berkshire Hathaway had taken a big position in UNH, and UNH is a Dow stock. It added 350 points that day, and that finally broke the February and going back to the end of last year highs on the Dow. So it finally joined the party of making new highs. But we're just kind of consolidating. We did have a big, huge move up in the Dow on Friday. So for now, we're just consolidating that move, staying above the 10-day moving average. So creeping higher. We are in the wave 5 here, but it's only a 71% extension. It could go higher from there. We'll see. What I'd be curious about is if we do get one of those FOMO moves from a rate cut, could that 5 relabel to a 3? And the reason that I'm saying that is the fact that the wave 4 only went to the 23.6% fib retracement level, which Elliott himself didn't really have a lot of confidence in. It also coincided with the 50-day moving average, the point of this triangle, some congestion from earlier in the spring. It was a logical point for the Dow to bounce, and then it played catch up, but we talked about in the past, thought that might happen. I didn't trade it. Not a big fan of trading the Dow. It's a little bit boring to me, but nonetheless, it did do what thought it might, and now we're at a new high. But the big news is all in still tech land, the mag stocks, AI, etc. So the Dow just kind of trending along, doing its thing, lagging a bit, but still following in place. The Qs would be really interesting to look at. You can see we had this really tight. I thought this was quite eye-opening. Trend channels are normal. They go back as long as any sort of technical analysis has been around, but the narrowness of this trend channel was pretty amazing to me. It was just a march higher, seemed to go up every day, kind of reminded me of 1999 and internet-based stocks. Back then, the NASDAQ just went up every day because of the view of the internet. The AI, very similar. At some point in time, valuations are going to get too high. They could go higher. They're pretty high right now, but we have corrected them just a bit lately. But the Elliott Wave algorithm still has the wave 3 green, meaning that that wave 3 is still active as well. We're holding right here at the 10-day moving average, and you know the drill. Zack told you about it at the beginning. It's gonna, all this is gonna, the Qs, all the AI stocks are gonna take their cue from Nvidia tomorrow. Not just what the earnings report is, but the guidance is gonna be key. How much weight are they putting China in? Some people think they're going to leave that out altogether in their press conference and commentary, but they're certainly going to get asked about it, whether or not they head it off or not. But at least we are holding the 10-day moving average, which is key. A lot of chatter about the IWM on the financial networks this morning. Huge move up on Friday. It was just, that was eye-opening as well. And it certainly gave you the impression that we're back in a risk-on environment. You probably know two main things about the IWM to know, the Russell. One, small caps, higher risk, companies with much smaller market caps, so they don't have the staying power of the big stocks, so or the big companies. So when you get a move up, it's kind of a sign of a risk-on type environment. And the other side of the coin, I guess it's just the same side of the coin, just another coin, is the IWM is viewed as being the most rate sensitive of all the markets. And if you wonder why that is, I just thought I would throw this in there. It's because smaller cap companies are growing. They're small market caps, they're getting their businesses going. Oftentimes they need to borrow money. So if they can borrow money more cheaply, Obviously, that helps them, helps the bottom line, helps them grow faster, allows them to borrow more money, et cetera, which leads into faster growth. That's why the Russell, in a very general explanation, is viewed as the most rate sensitive, because those companies need to borrow money. They don't have big war chests like Apple, et cetera, of cash just sitting in an account somewhere that they could draw on. They need to constantly be borrowing money and investing and growing their business. And you can see a tick up on the IWM today, even with a just tiny bit of a tick up on the longer end of the yield curve. So perhaps it's reacting a little bit more to the lower end of the yield curve. Let's get into the crypto space. Looking at BITB. This is where there's a little bit of danger, Will Robinson. If you're a crypto fan, you can see this drop down, and we were opining yesterday with the break below the 50-day moving average. Would we get follow through today? Now, I mentioned in last week's U.S. market update, not this past weekend, but the one before, Tom Lee had come out and said that he felt like Ethereum was going to take over for Bitcoin. They were going to flip-flop, and Ethereum was going to be king and not Bitcoin, which kind of looks like a little bit of what's going on. But if we hold here and we don't move back to the upside more towards this 60 level on the calendar rollover, I know cryptos trade 24/7, but there is still a calendar rollover for end of day charting programs like I'm showing you here, so that you get these bars. A follow through day to the downside would be problematic for Bitcoin. We could come down at least to the point of this triangle, or possibly even lower, maybe down to this level, and the possibility of coming all the way back down to this previous 4 is a possibility as well. So that would be in the 55 range on the BITB. I know a lot of you like IBIT. They're very similar. Both of them track about the same. Both of them have very liquid options. The IBIT does have weeklies, which the BITB does not. So if you're trading on a more shorter term basis, maybe you prefer the IBIT. But either one of these is a good way. And people ask, why would you show the ETFs? Why not just go buy partial coins? Because I made a joke one time that this was a good way to trade if you didn't have 100 grand to go buy a Bitcoin. Of course, you can buy partial coins, but you can trade options on these ETFs, which gives you much greater leverage than buying partial coins. So it is a good way to trade from that standpoint. Now let's look at Ethereum, which is actually up today. So is Tom Lee correct? Are we getting a flip-flop? Certainly acting better is Ethereum than Bitcoin. So we'll see if that continues back to the upside. There's been some forecasts that Bitcoin would hit 200,000 by the end of the year. It's got to get off the mat and get going if it's going to do that. But Ethereum hanging in there very well in this stair-step pattern. We had this big move up, got a little vertical, came back down to the 10-day moving average, held that pretty well, had a big, huge, massive up day on Friday and consolidating that pretty well, also staying above the 10-day moving average. So just from a purely technical standpoint, the chart of Ethereum is much better. Let's see if this will give us enough data points yet. Nope, not quite. Hasn't been trading long enough to give us a potential Elliott Wave pattern there. I can change this. This is something that's kind of cool. If I change it back, I have 377 data points, as you can see on the bottom. If you wonder why 377, that's a weird number. It's in the Fibonacci summation series. It's a number. Standard, if you get the software, or when you get the software, it's 300 data points. That's how it's calculated. But I like having the idea of not 4,300. Well, I was going to change the data points there to 300, but there we go. And let's see if that gives us an Elliott Wave count. Nope, still not enough. So then you can go if you want to. I've shown you this before. I'm not a huge fan of this, but some of you ask because you want some sort of a count on the data. And so you can um, change that appearance to 100 if you want. Let's just do 130 for the heck of it. That'll give us an Elliott Wave count. And as you would expect, it's in a wave three to the upside on Ethereum, also on an active wave. But that's a pretty low data count. So I wouldn't put a whole lot of faith in that. I think you kind of want to go with something a little bit longer term. And I like the 377 for the data points. Again, I am a Fibonacci fan. Most of my settings, because you can change just by showing that cog in any indicator. It gives you your favorites over here. So whatever your favorite indicator is, you can alter the data points if you choose. And I make all mine Fibonacci numbers, just because I'm I'm that big of a believer in Fibonacci. All right, let's move on. We'll get to energy, and they had I was talking about this yesterday to our EWO Live group as well. That there was a natural gas expert on, and they're obviously asking him what is it going to take to get a bid under natural gas. I've talked about this a lot. We know that there's going to be demand there with the new data centers, especially now that President Trump is kind of getting negative on solar and wind power. The electrical grid can't handle, at least expectations are, it can't handle the increased demand from these data centers. So they know that they're going to use natural gas, but we don't know how much the demand is going to be. And the fact that we're moving into the winter, I keep saying this and I keep forgetting to do it, to look at the Farmer's Almanac to see what the forecast is for this upcoming winter. I would imagine that if it was viewed as being colder than normal, I traveled a lot this summer, and I can tell you there are places that were quite warm, warmer than normal. So I was wondering, could we have places that are colder than normal for the winter? When you get one extreme, usually it corrects with a extreme the other way, but it doesn't look like there's expectations of that. So the supply side, and I've talked about this numerous times as well. If you wanted to summarize how the markets work, supply and demand based on fear and greed. That's in a very general statement how the markets work. And in the case of natural gas, we're the Middle East of natural gas, lots of supply. Even though there's increased demand, supply is still outpacing expected demand. At some point in time, I think we'll get a corrective move here as the wave 5 continues to extend past 100%. But now, because the wave 5 is extended past 100%, you don't look for a move back to the previous 4. You get some sort of a Fibonacci retracement. The first level of resistance is right there around 15. Perhaps that would be a technical bounce, but we will exhaust the sellers at some point in time. That's just the nature of how markets work. Regardless of the supply demand side of things, at some point, those that have wanted to sell will have sold. And then, even though there may not be a lot of buyers, the buyers will outpace the sellers, and then we'll start to move back to the upside. So perhaps it's not a supply demand issue that drives natural gas back up. Perhaps it's just an old technical. The sellers are exhausted. How much lower can natural gas go? At least as evidenced by the UNG. And then looking at USO, same old thing here. Q Led Zeppelin, song remains the same. We're just in this big trading range that I talked about in the market outlook. I talked about it at the update for the rest of the year, that I felt like oil, at least by the USO, was going to stay in this big trading range. That's where OPEC Plus wants it, slightly elevated in price, but not extreme. On these two highs, they increased production both times to bring the price back down. They do want to make as much as they can on the supply that they have left. but they don't want oil to get outrageous to the point where it drives a bunch of people into electric vehicles, because that kills the demand side of the supply demand curve. So not much changed on USO, acting exactly as you would expect it to. Let's take a quick tour around the world. Australia did pretty well, playing catch up from our Friday, and then just kind of hovering around that 27 level. It finally got there. As you know, back here when we broke 26, I thought we were going to go to 27. We got close in June, came back down, tried it again in July, came back down to the 50-day moving average, and then finally was able to break it, but it got sold into immediately. So we're just kind of teetering around 27, perhaps a breakout in gold. We'll do it. We'll get to the metals after we do the around the world tour. Taking a look at Canada. This is another chart that has been very surprising to me this year. Just with all the rhetoric back and forth on the tariffs and everything else, the EWC has just ignored it all and continued to go higher. It did have a blip down during the tariff tantrum in April, but since then, just tracking higher, made a new high on Friday and holding the 10-day moving average there as well. And maybe that's what continues just to bleed to the upside. But it's just been amazing to me, considering the fact that we've had so much talk back and forth, threats back and forth, whatever you want to call it, on the tariffs between the U.S. and Canada. The market in Canada is just blowing it off and feels like that everything will be fine. The EWG ran up, and this is, people have asked why do markets like rate cuts? It's like Kool-Aid for them. It takes a while to work its way through the markets. People were asking also yesterday if I thought inflation was in an area where we could cut rates. And I don't know. I think it's showing that the inflation, while small, but it's there from the tariffs, has appeared, but the tariffs aren't as high as what was once expected. And so with that, the markets have been able to handle the inflation. I'd like to see rate cuts because I'm concerned about our debt. That's the main thing, is the fact that if rates come down, it costs less to service the debt. And we're going further into debt, not just from the bonds and treasuries that we auction off every week, but paying the interest on the bonds and treasuries that have already been purchased by a great number of other countries. Japan and China are the two biggest holders. So I would like to see a rate cut. I'm not necessarily a fan of the 50 basis point rate cut scenario that reared up again this morning. After the FOMC meeting, there was almost zero chance of a 50 basis point rate cut, and the chance of September came way down. And now, not only are we pricing in a September likelihood of a rate cut, but now we're getting the whispers of 50 basis points. I would be shocked if the Fed did that. But we'll see. They're going to do what they're going to do. For now, once the ECB stopped cutting rates, you could see what happened. So the EWG was running up, even though the fundamentals in Germany and the economic data did not support such a big rally in their market. But the ECB cut 200 basis points of rates, and there you go. That's how markets react to rate cuts. Now they've paused, and so the EWG is on pause as well. So almost right on cue with when the ECB stopped cutting rates and went to pause, they call it. So did the market in Germany, and we've got a bit of a symmetrical triangle. We're going to see a break one way or the other there on the EWG. Plus, it's extended past 100%, which may be it. We might be range bound, but we'll get a little bit of a breakout from this triangle at some point in time. Looking at India for the Nifty, talked about this recently as well. We had a bit of a move, as it seemed like things were okay, especially after Tim Cook met with President Trump and Apple can still make their iPhones in India. They're just going to invest an additional 100 billion into U.S. companies. That put a little bit of a bid under the market in India, and you can see right back down. So we need to find out if this wave 4 is going to hold. We are below the major moving averages. So if you want to go long the market in India through the Nifty or INDA, I think caution is the word right now. You would want it back above all those major moving averages. And that would even be aggressive to come in before these highs from August were taken out. The more conservative approach, if you wanted to go long the market in India, is wait for those highs to get taken out. That would be a likely point to come in. And then we had a lot of talk about a lot of the questions yesterday from our subscribers came from stocks in China. And it does appear, as President Trump keeps rolling out the deadline for China tariffs, that he's at least constructively optimistic on the way the talks are going, that some sort of a deal is going to get worked out that he'd be happy with. And so there's a lot of China stocks that have a bid. And then you can look at the FXI for a generalized ETF of China stocks. And you can see it's trading higher, made a new high above that previous wave 3 and holding above the 10-day moving average nicely there. Let's take a look at gold. It's trying to sneak out, but that does not count as a breakout yet by any way, shape, or form. So we have to wait for a confirmed breakout. You can see we have the pattern of lower highs. So we need to take out at least this high here, if not this one, to get a confirmed breakout. Because it could just be, if it turned around right now, it would just be extending the triangle. However, I have given you likely target prices. If we break to the upside, probably up around 330. If we break to the downside, more likely around the 290 mark. But once again, you don't try to guess what direction it's going to go. GLD has been in corrective mode ever since this wave 5 ended over here back last winter. And then we had a zigzag there. We had another zigzag here. Those are corrective patterns, even though they're directional in nature. I love trading zigzags, as you probably all know. And then we went into a large symmetrical triangle. That's why there's no Elliott Wave labeling. Question's been asked as well, because it's in a corrective phase. We'll see which direction it breaks out. Perhaps it breaks out in an impulsive pattern once again then. But for now, we wait and see on GLD. SLV formed its own little triangle, tried to sneak out to the upside. And as I talked yesterday as well, when you see this, there's one of the 3 ways that triangles normally break out. One way is that they take off and run, whether it's to the upside or the downside. Another way is you get a breakout and then you come back and test the point of the breakout. Notice we did not get a follow-through day on the big move up on Friday. Pretty much everything was up on last Friday. So sometimes you break out, test the breakout, then you run. And then the third way is that you get a false breakout. It looks like you're breaking one direction and the big move is the other way. So on both gold and silver, we have to still respect there could be downside move, but this wave 4, the AI had given us this target back here in early June, and we just pegged there for a month, then broke higher, formed this triangle. We have a nice Elliott Wave pattern set up here. It's nice and symmetrical. That's why I've drawn these lines here to show you the symmetry in the pattern. That matters to me. I'm very visual. My IQ test says that I'm adept at visual spatial identification, which is basically patterns. So I feel like I'm kind of doing what I'm supposed to be doing, analyzing charts, and at least by the IQ test, I'm decent at it. So with that, Zach, we'll go ahead and open it up to some questions before we get to the case study consideration for this week. And I will review last week's DXJ on some of the international rotation. If we do get good numbers out of Nvidia, because there has been rotation into other sectors in the market, will that roll everything back in to big tech? I think that's going to be another piece of the Nvidia earnings puzzle tomorrow. Is what are the numbers? What's the guidance? And if it is good, does that re-rotate money back into the big tech stocks? So lots of stuff to look about with the earnings from Nvidia tomorrow. Okay, Zach, let's do some Q&A.
Sounds great. We'll open up the Q&A with symbol, excuse me, open, OPEN.
Open text. That's that. You know, I talk about this each and every week, but I really like the questions that come from the TradeFinder, where you get stocks that we don't normally look at, and you get tired of looking at the same stocks all the time. We're right at the $5, so I think this is likely a favorite of the meme crowd. I don't really follow that too much, but they've gotten it up to $5. Now the question from Open is, you want to watch the volume. So you've seen some spikes here. Can we get to the point where institutions, bigger institutions, come in? And I've talked about this a lot. If you're a newer viewer, the two key levels to watch are $5 and $10, because by security regulations, only companies that have aggressive growth as their investment objective can own stocks at $5 or above. Before that, it's mostly retail trading or some other entities that can have some volume to drive the price higher. But if you get above $5, then you can get some of the bigger institutions involved. And then if you get to $10, that's where any investment company with the investment objective of growth, so growth, mutual funds, et cetera, growth and income, those can all own stocks at $10 or above. So that's the next level. So what you want to watch is, can we get some significant volume coming in here to show that there are some of the more aggressive minded institutions taking positions here. So we got a little bit overbought, but we're consolidating that nicely. You know the rule: you get too far from the 10-day moving average, nothing does for very long. We always come back to the 10-day moving average. Most people that have been with Evo Trader for a while say that one tip has helped them as much as anything else. No security any time frame gets too far from the 10-day moving average for very long. And you're going to either come back down towards it, or you're going to consolidate and let the 10-day moving average catch up, or some combination of the two. So if you like this stock, if you're long, no reason to get out at this point in time. If you're looking for an entry, keep a close eye on that volume. And if you start to see the volume pick up significantly above 5, then it will probably propel it higher, because there's some shorts here, I'm sure, because we got turned back down in July, all the way back down to $2 the last time we hit 5. And so the program traders will put their shorts here. You can see that we traded up to 6, but we closed all the way on the low in the day yesterday, and we're hanging in here now. But if we get above 5 again, watch the volume. That's going to be your key. If you get significantly above average volume kicking in, then you're probably off and running. But for right now, I just watch it.
Thanks, Rob. Let's head over to cost from there, COST.
That's going to be interesting, isn't it? Been lots of talk about Walmart, and they said that, yeah, there's been tariffs, but they've handled it pretty well. Target's been struggling, and they've been kind of moving in the right direction, supposedly from channel checks. I always thought the Target stores looked nice and clean inside, but they got off kilter on their inventory. They're trying to redo things. But if we are back into a risk-on environment, which is what it showed with the Fed being a little more dovish than expected in Jackson Hole, stocks like Costco, Walmart, Target, Pepsi, Coke, all those are not going to get as much interest as they would have if the Fed stayed in their hawkish stance and money was rotating towards more defensive minded sectors, which is where discount retailers are. So Costco is getting hurt by that. Plus, it hit $1,000 again. So we got up here above 1,000, came back down, got all the way back to 925. We hit 1,000 again. But note that we do have a qualified zigzag pattern to the downside, which so far is working with a perfect B wave correction at 50%. I like 61.8, but 50 is solid as well. And we're moving down. We're a little bit oversold right now. So I'm watching Costco for a short position. You can see the increased volume on the way down. And again, I think that's just attributed to the market has a higher taste for risk right now than these more conservative discounters. We're a little bit oversold at this point. The level I'm watching is where that A wave low is. If we can break below that, then I do think there's a good chance this C wave extends and we head back down towards 850. But we're a little oversold right now. We're awfully close to that. Let's just be a little patient here and wait and see. If you're trying to go long this stock, there's nothing really that's enticing unless we're able to get back above 975 and all where those major moving averages are, the 10, 30, and 50, all at the same spot. More conservative entry would be just let it get back above 1,000 and see what it can do. But for right now, the sector is not going to be too much in favor. They're going to have a blowout earnings report or something to get interest back in there just by the nature of where psychology is in the markets at the moment.
Next up, we have IONQ.
Oh, gosh, I haven't looked at this stock in forever. Again, you guys, you come up with these symbols that are just blasts from the past, stuff we don't look at very often. I'll stop rattling on about that, but that's the reason I love this show each and every week. So we're just pegged right here at 40. The major moving averages are all converging. It's not really a triangle pattern. It's more of a channel sideways pattern. And the reason, if you're wondering, why do you have the line there and not up here? And I wouldn't argue with you if you wanted to put the line up here, but I've got it right through here because this is what I call congestion. We're trading through this level at 40 consistently. You get a little above it, you come back down, almost like the 10-day moving average thing. So it doesn't seem to want to deviate from 40 too much. Looks like a pretty good sideways trade. I don't know what the liquidity looks like in the options. Let's take a quick look and see if a sideways trade. Wow, there's good open interest in this stock or in the options on this stock. So you could do some sort of a calendar spread or something on IONQ and try to generate some income like we do in the time strategy portfolio at Evo Trader. So yeah, good liquidity. I like the put side. It's not quite as heavy as the call side, but the spreads they're okay. They're not great, but they're okay. And if you look at the 40 strike, which is where we'd be, that has the best open interest on the put side, and the spread is fine there. It's only 9 cents wide, which is right in line with where actually tad low of where we would need it to be. So yeah, I think something sideways here until IONQ shows us something different makes a lot of sense there.
Thanks, Rob. Let's head to Palantir, PLTR.
You know, they were talking about that on the financial networks this morning as well. Jim Cramer was saying it's time to get back into it. So I don't know if that's the kiss of death. I can remember back when I was doing live seminars, people in the audience would talk about the Cramer fade trade, where if he touted something, you go the other way and vice versa. But Palantir got way ahead of itself, got too vertical, got too far from the 10-day moving average, gapped up and went vertical. So it's got three negatives there. It was destined to come back down to reality, which it did. It's still a very pricey stock from a valuation standpoint, but so are most of stocks in tech land, overvalued. So it is encouraging to hold the A wave high, hold the 50-day moving average. We got past the 161.8% extension, so it even blew past an extended C wave. It had a B wave at 61.8. That tells you that you're looking for 100% extension. You can see it traded there for a week right there, and then periodically the C wave will extend to the next fib level. You usually get one extension, every now and then two, but oftentimes you'll get one. And it even went through that. So it was way overvalued up here, or way too vertical at the 190 level, and came back down. So the speculation now is that we do see 200 in Palantir at some point in time. The Fed easing is going to help with these companies with higher valuations, just because, again, of the psychology of what rate cuts mean. But the 10-day moving average is so close. I normally give an aggressive or more conservative stance on these when analyzing charts, but in this case, we all have different, risk tolerances, and stay within your own. That's where you're going to be the most comfortable. But this one, it's so close to the 10-day moving average. There's no reason to get super aggressive right now. It is encouraging that it held the 50-day, and if it can get back above the 10-day, we might be off running to 200. But I would want to see that 10-day moving average broken first.
Next up, let's go to Rivian, RIVN.
I've noted this before. The cars are way better looking than the stock, but it's hanging in there. We got a wave 5 to the downside here. We made it into the tap box, time and price projection. We're moving back up. When a wave 5 ends, you expect to go back to the previous 4. We are above the 10, 30, and 50-day moving averages. So here's where I will do the aggressive versus conservative approach. If you're very aggressive, you can go long now with the expectation of moving back up to the previous 4, which would be the target price, the first target at least. The more conservative approach on that would be to let that 10-day moving average cross the 30. So the 10-day is the lime green line, the 30-day is the fuchsia colored line. You can see we're almost there, but let them cross. And if they cross, then you get in. Obviously, you may miss a little bit of the move by doing that, but that's the nature of being aggressive versus conservative, right? If you're more conservative, you're not going to get as much of the move, but you're taking a little bit less risk. So that's basically all comes down to risk tolerance in the markets, but they are definitely cool looking cars.
No doubt about that. And from there, let's go to Reddit, RDDT.
REDC.
Sorry, yeah, RDDT, Reddit.
Okay. Yeah, you are a little stuffy, so.
Yeah, sorry about that.
Reddit, gosh, I'd like to see a lot of the Reddit people come over to the social media platform on this hub software, because they are so respectful of others. I'm sure Zack will talk about that when we do our case study consideration for the day. You can get some pretty terse messages with the crowd on Reddit. So if you want a place where people are going to respect differing opinions, go to the social media part of the hub platform, which is really cool. Anyway, with Reddit, surprising numbers on its earnings report. Had a big run, too vertical, so we came back down. We're consolidating. How far do we go? Do we come back down and test 200? We might. And we're below the 10-day moving average. If it closed where we are right now, we'd have a doji, but anything can happen in the last couple of hours of trade. So we'll see if that holds. But You definitely want to be back above the 10-day moving average if you want to go long this stock and see if it can make another push to 250. But for right now, until it gets back above the 10-day moving average, you also have to respect the possibility of coming down and at least testing 200 and the dreaded gap down here on the earnings report also looms out there. Most gaps get filled, not all. We've talked about that in the past, but our AI data shows us that vast majority do. Gemini AI, wherever you want to look, shows most gaps get filled, but you don't know when. It could take a long time before the gap gets filled. Some get filled immediately, some take quite a long time. But anyway, going back to the analysis of Reddit, I don't think you want to go long until you get back above the 10-day moving average because the possibility of 200 is still there. So if you're long the stock, I would be careful unless you would be all right with a test of 200. If you're like, oh, I'm in it for the long term. If it comes down here, ho-hum, maybe I'll add to my position, whatever. But if you're looking for an entry, let it get back above that 10-day moving average in 225 and see if it can mount some sort of a run from there.
Let's check out EGO, EGO.
All right. Eldorado Gold. Going to kind of tie in with our case study for today. Very, very similar scenario here. You would think that with these miners breaking out, that gold would be already broken out of its triangle, at least by the GLD. Hasn't so far. Interesting that the miners seem to be getting in front of the metal. It's usually the other way around. But that's a solid looking chart. We are at the upper end of the tap box, but let's see where the DMI looks like we're just getting going. In fact, you would want to see that ADX, pardon me, above 20, but there's good separation between the two directional indicators. Maybe just give it one more day. Make sure that ADX does actually break 20. I've talked about this before. It can roll up and roll over, but that looks good to me. That's a good looking chart and looks to go higher, in my opinion, unless we get some sort of a massive downward breakout in GLD, which is a bit hard to imagine. Gold trades a lot with the dollar, and if the Fed does cut rates in September, certainly doesn't seem like that's going to put a bid under the dollar. And if the dollar weakens a bit, gold's likely to go higher. And the miners, again, seem to be actually leading the metal. Very odd, but that's a very good looking chart, in my opinion.
Alrighty, thanks, Rob. See, we have about 1 minute left. As always, we got tons of outstanding questions still remaining, but I didn't know if you wanted to head over to the case study consideration now, or you tell me.
Let's do one more. Pick one more question, and then we'll do that.
All right, let's check
We
out.
are going to do AI alert in this one, so everybody wants to hang around for that.
Very well. You heard it here first. Last symbol will be SBET.
SBET. Is this do you know
Sports betting, I believe.
sports betting? Okay. We've got a pretty well formed descending triangle here. You don't have to be a accomplished technician to see this series of lower highs and the support right there at 20, holding very tightly. Football's about to start. Usually a very good time of the year for the gaming stocks. They tend to peak out around the Super Bowl. I'm not familiar with this one. I like the symbol though, SBET. So sports betting, I guess, is where that came from. Remember that a descending triangle does not necessarily mean a downside breakout. Any triangle can break either direction. So good pick on this one, Zach, to allow me to reiterate that. And it does seem that, see, here's what happens when institutional ownership comes in, you can see how when it broke above 10, some volume came in, wasn't enough. And so it got vertical and came back down, hovered around 10. And this is where the institutions came in and supported it at 10. So exactly what I was talking about before on the importance of the $5 and $10 price levels. This is what it looks like because the stock came down to 10. Institutions own it. And there's a period of time if the stock trades below 10, those that don't have aggressive growth as their investment objective have to sell. That means realize the loss. They don't want to do that, so they tend to come in and support it and see if they can create a short covering move. So that's kind of what I was talking about before, watching the volume interest on a move above 10. So perfect example there. Great pick on this chart, Zach. So again, a final reminder that the descending triangle means a breakout. It does not necessarily mean a downside breakout. It could come down and test 10 again, and then we'll see if the institutions come in. You would think the fundamentals would favor an upside breakout moving into football season, but you never pick a direction on a triangle. You have to respect it could move either way. We can come up with a whole bunch of reasons, just like on gold, on why this should break higher, and maybe it does, but you have to respect both directions. All right, Zach, good call there. We're going to look at symbol B, and we just looked at El Dorado. This is Barrick mining, used to be Barrick Gold. And the AI has given this only a 68% score, which is a little lower than what we normally look at. But as you saw with El Dorado and at least the elevated price of GLD, unless it gets a significant downside breakout, this looks pretty solid. And then when you look at the DMI, you see good separation between the two directional indicators. The ADX is only at 35, so it has more room to run. Very supportive DMI there on that chart. And so our target price is going to be 28.85 on this one, Zach. This will be an official idea. And I'll come back to that in a moment, but I did promise to update you on last week's. So let's take a look at the DXJ. Hasn't done much since last week, trying to hold that 10-day moving average. The DMI is still supportive, and the algorithm still has the wave 3 as active. This one was even lower at 62%, still better than a toss of a coin. The only negative here could be if Nvidia comes and blows earnings out and money starts rotating back into the tech stocks, does that international rotation end or does it continue? So that would be the concerning thing to watch there. And if Nvidia just kind of comes in line, it's ho-hum, I think that keeps the bid under the rotation. So I thought I would show you that. But going back to B, you can take it away, Zach.
I was just going to say, with us being after time there, Rob, we'll just to go ahead and get it posted as soon as the session concludes. But if you just want to add your final thoughts around the case study B for this week and any other closing thoughts, we'll thank everyone for taking time out of their day to join us as always, and should be an interesting remainder of the trading day. See how everything closes.
Sounds good. I think I did a pretty good dissertation on the social media aspect of the platform anyway today, so that's fine. And we do value your time. We're very respectful of it. Time is the most valuable asset all of us have. And so we appreciate you spending some of your trading day with us today. And, we're just going to see what the market has in store for us. The telltale sign for the tech sector will undoubtedly be Nvidia, maybe even the S&P. In tomorrow, and then we will keep our eye on that Fed meeting. We get the PCE report first, and I think it's the 16th and 17th is the Fed meeting. I think those are the right dates. Don't hold me to it. 2-day meetings, so we won't get the results till Wednesday, and then Chairman Powell will do a press conference following that, and I'm sure the Lisa Brown thing is going to be big and all that stuff. So Chairman Powell in his last year has faced some meetings that I don't think he really wanted to be involved in. But thanks again for your attention. You know what to watch for. See how things shake out over the next couple of trading days and what Nvidia has in store for us. Look forward to talking again soon. Take care, everybody.